It has been confirmed from multiple interviews that Trump has done recently in March of 2025 that he is planning on crashing the stock market. He said it in multiple different ways but not directly. The reason why he's doing this is because of two main reasons. First and foremost, he said that any short-term pain will be worth it to bring manufacturing back to the country. He is not even looking at the market because long-term, the United States will be very strong from what he is doing. So he's saying that short-term, yes, there's going to be pain, but long-term, he's doing these things in order for the United States to have a stronger foundation. He also said that it's going to take an adjustment period for folks on Wall Street, aka people that are involved in the stock market. It's going to be an adjustment period because the market was just straight up and to the right for the longest time. Now he's saying that the adjustment is likely going to bring equities down. The reason why he won't say it directly is, number one, to not make the markets completely panic. But it is so obvious that this is why he's doing it. One, he's had arguments, or at least stated several times, that Jerome Powell needs to bring interest rates down. He's been saying that for about 6 months, even before he was in office. He's been saying that because the economy desperately needs lower rates so that people can borrow more money, invest, do business, and spend more money, which will help the overall economic climate. But Jerome Powell is keeping interest rates high because our inflation rate is still sitting right at 3%, which is 1% above the target inflation rate. Trump knows that $7 trillion in debt is coming due over the next 6 months. He has compared this to the 1929 Great Depression because he knew that he was stepping into this situation. The previous administration, he thinks, potentially purposely put him in where he now has to refinance $7 trillion at really high interest rates, which would be very tough for the overall US government and probably throw us into even more debt. He's sitting at a mountain full of debt, and he's claiming this is before he even came in as the president. On December 29th of 2024, he's saying that this could be the next Great Depression because of what he's stepping into. What he's mentioning is this $7 trillion in debt that is coming due. Why would he want interest rates to go down? First of all, how would interest rates go down if he puts pressure on Jerome Powell to decrease rates and he's still not doing it? What will get Jerome Powell to decrease rates is if the stock market starts to decline. He is purposely saying the stock market's going to feel some pain. He's going to shake up things around the world with all these tariffs and do what he thinks is necessary to set the country on a good foot in the next few years. But short term, you're probably going to see some pain. That pain is not going to be alleviated until we bring down interest rates because he knows he's got to refinance this debt, this $7 trillion. What is he doing? He wants to crash the market so that Jerome Powell says, oh man, the markets are way down, I need to bring interest rates down to stimulate the economy to make sure there's not that much pain. He is going to do all of these things that he thinks is probably good for the US economy long term, but short term it's really going to shake things up. It's going to create fear in the markets. It's going to bring the stock market down, which would incentivize Jerome Powell and the Federal Reserve to bring interest rates down so that he can issue more bonds, likely a 10-year bond, and refinance all of the debt that is coming due this year at lower interest rates. If he's refinancing at a really high interest rate, that could be tens if not hundreds of billions of dollars over the 10-year note. That is what is happening right now. If you look at historically where the bond market is relative to stocks, it has been held down on one of the worst bear markets that the bond market has ever seen. Now look at this discrepancy of where bonds are. Bond prices are in the blue, the stock market is in the red. We've never seen this much divergence before where the equity market went this far up and the bond market came down into the worst bear market that it's seen in a very, very long time. Now we're kind of forming a technical pattern which I'll talk about in another video. Just look how much divergence in the price that we're seeing. Stocks at way all-time highs, bonds at practically all-time lows. What we're looking at is TLT, which is a bond index, and then the S&P 500 in the red. What he wants is he wants interest rates to come down. If there's a recessionary scare, which we have talked about recently, the Fed has actually put out a new piece of data where they are now projecting that the GDP is going to grow or go down from above 2% to almost negative 3%. They're saying yes, there is a recession likely coming because now we're changing our projections of GDP by 5%, which is a drastic change. What happens? Bonds do well when there's a recessionary scare. There's fear in the markets and when investors feel like equities are overvalued and they want a flight to safety. When they want a flight to safety, when there's fear in the market, when the market's going risk off, when investors want a yield, they want to be paid a dividend instead of just holding an equity and hoping for appreciation. Guess what they do? They sell equities and they buy more bonds. This could be set up as one of the top trades of this year simply because of all the things that are happening with Mr. Trump and the Federal Reserve. Credits, FinShots, Hindustan Times, The Spectator.